You earned well this year, you have a CPA, you kept your records clean, you did everything right, and you still feel like you owe more than expected. That feeling sitting across from your accountant, that quiet frustration, that is not bad luck. That is what happens when the entire tax conversation begins in April, because by the time you are in that meeting, the income has already landed. The structure was already decided, the classifications are already set, and at that point, there's almost nothing left to do. The earners who consistently keep more of what they earn did not find a better CPA. They changed when the conversation started. In this video, I'm going to show you exactly what that looks like before April 15th hits. Not generic filing tips, not basic reminders, the specific things that matter most when income is at a serious level, and the mistake that quietly costs high earners the most every single year. Stay with me, the section coming halfway through this video is the one most people at this income level have never had explained to them properly. Let's get into it. The real problem. Every April, the same conversation happens. You sit down with your CPA, they walk you through the numbers, and somewhere in that meeting, you feel it. How is it still this high? Most people do the same thing at that moment. They assume the system is just expensive at this level, so they accept it and they move on. But here's what is actually happening. The tax system was not designed to treat every dollar equally. It was built to reward certain structures, certain behavior, and certain types of income. If your income is flowing in the most straightforward path possible, a W-2 salary with no intentional design, no positioning before it lands, you are sitting inside the most tax category the system offers. Not because you did anything wrong, but because nobody showed you there was a different way to think about this. That is exactly what happens today. Let us start with deadlines, because missing these does not just cost you stress, it costs you real money. If you have an S Corp or a partnership, your business return is due on March 16th. This is before your personal return, and here is why that matters. Your business return generates what is called a K1. That K1 feeds directly into your personal tax return. If you miss March 16th, then your personal return is automatically delayed too. One deadline missed, two problems. Penalties on late S Corp filings can exceed $220 per shareholder per month. For sole proprietors and single member LLCs, April 15th covers both your business and personal return. Now extensions. This is where a very expensive mistake happens repeatedly. An extension gives you more time to file. It does not give you more time to pay. Whatever you owe is still due by the original deadline. You pay late interest, no exceptions, plan accordingly. The real conversation, the one most high earners never fully have, is about what is actually driving that number. And it starts when something most financial content skips over entirely. How your income is structured determines how it is taxed. Once you see this clearly, the whole picture changes. Structure. This is where most high earners have their biggest blind spot. It is not just about what you earn, it's about the path that income travels before it reaches your return. Sole proprietors or single member LLC business income flows directly into your personal return through a Scheduled C. Simple structure, but here's the cost of that simplicity. You pay income tax and self-employment tax simultaneously. That is 15.3% on top, covering both sides of Social Security and Medicare. Because when you're the business, you are the employer and the employee at the same time. The number quietly surprises many people earning at this level who have never examined it closely. S Corporation. This is where the conversation becomes more strategic. An S Corp passes income through your personal return via a K1. But as an S Corp owner, you must pay yourself a reasonable W-2 salary first. This is not optional. Distributions above that reasonable salary are not subject to self-employment tax. The distinction between salary and distribution is one of the most powerful levers available to high earners operating through a business entity. But underpaying yourself to reduce payroll taxes is also one of the biggest audit triggers the IRS watches for right now. I will come back to that shortly, because what is coming in the audit section is something that most earners at this level genuinely never see coming. First, let us talk about where real money is quietly being left on the table every single year. Deductions most high earners miss. This is not about writing off your lunch. This is about structural deductions that only become available once income is intentionally positioned. The difference between knowing these exist and not knowing is not small. Retirement contributions, most high earners treat retirement as wealth building, and it is, but it is also one of the most powerful legal tax reduction tools available, and most people are not using it anywhere near its full capacity. A SEP IRA allows contributions of up to 25% of net self-employment income. A solo 401k through an S corp pushes those limits further. And in certain situations, defined benefit plans can create deduction opportunities that most earners at this level have simply never been shown. The insight here is simple. Retirement is not just a future strategy. Used correctly, it is a present year tax positioning tool. The home office most S corp owners get wrong. If you work from home and operate through an S corp, you cannot deduct a home office directly on your personal return. But your S corp can reimburse you for that usage through something called an accountable plan. That reimbursement becomes the deductible business expense at the entity level. Most people never set this up, and they leave that deduction on the table every single year, not because it does not apply, but because nobody explained the correct setup. Health insurance premiums. If you are an S corp shareholder owning more than 2% of the company, your health insurance premiums are deductible, but only if correctly reported on your W-2. Set it up wrong and the deduction disappears entirely. This setup matters just as much as the strategy. Now here's where I need your full attention. Everything we just covered, the structure, the deductions, the positioning, all of it only works if you stay clearly on the right side of one line. And right now, the IRS is watching high earners more carefully than at almost any point in recent memory. Here's exactly what draws that attention. Audit triggers. The IRS is not manually reviewing returns one by one. They are running automated systems that cross-reference what you report against what banks, payment processors, and 1099 issuers have already reported about you. The gap between those two numbers is what gets flagged. Trigger 1. Unreasonable S corp salary. If your S corp generates $400,000 in revenues and your W-2 salary is $40,000, that ratio creates an immediate flag. Your salary must reflect what someone in your role would realistically earn in your industry. This is one of the most common and most avoidable audit triggers for high earners. Trigger 2. Expense ratios that do not match your industry. If your revenue is $300,000 and claimed expenses are $260,000, the system notices. Legitimate deductions are worth claiming, but when your expense ratio looks dramatically different from what is typically in your space, documentation becomes everything. Trigger 3. Income that does not match what was reported about you. Every 1099, every W-2, every payment processor reports. The IRS receives copies of all of it. If what you report does not match what others reported about you, that discrepancies gets flagged automatically. Every source, every platform, and it all has to be reconciled. Let us take a step back. Everything covered today, deadlines, structures, deductions, audit awareness, none of it is complicated once you see how it connects. But here's the real truth. Most high earners are not losing money because they made a mistake. They are losing it because the conversation about their income starts too late. By the time April arrives, the income has already landed. The structure is already in place. The classifications are already decided. The earners who consistently keep more of what they make did not find a secret. They simply decided that how their income is designed deserves the same attention they gave to how it is earned. The shift from reactive filing to intentional positioning is where real capital perseverance begins. To be clear, everything in this video is educational content only. It is not tax, investment, or financial advice. Every situation is different, and any strategy worth considering should be evaluated with a qualified professional who understands your specific picture. But here's what I've seen consistently. Most high earners walk into their CPA's office every April with no framework, no awareness of what to even ask, and when you do not know the right questions to ask, you cannot know what is being left on the table. If this video shifted how you think about your income and you're starting to wonder whether your current setup is actually working for you or simply working at all, the link in the description is where the next conversation begins. It is a strategy call. We look at how your income is currently flowing, where friction may exist, and whether there is a structural adjustment worth exploring in your situation. This is not for everyone, so if you're making a strong income and no one has ever walked you through how it is actually structured, that conversation is worth having. Because at this level, taxes are not just an expense, they are a designed decision. And design always comes before the next dollar lands.